Banks hate me and they hate HELOCs. In this video, I'm going to go and break down exactly why banks don't like lending out HELOCs, expose what the banks do after the fact that they lend you the HELOC, as well, why do banks exactly hate me? Hey, what's going on, everyone? This is Kwak here, one of the Kwak Brothers, and by now you know that we are a huge fan of using a HELOC to paying down your mortgage, as well as buying rental properties and investing in real estate. Well, a lot of times I get questions like, Sam, how come banks don't know about this? Or I go ask my banker about getting a HELOC and he tries to brush me off and he doesn't want to talk about HELOCs. All he wants to do is talk about 30-year loans. Or, I go talk to my bankers about using the strategy of using a HELOC to pay down the mortgage, and they have no idea what I'm talking about. So I'm going to go and answer all those questions and explain why banks don't like lending out HELOCs. Now, before we do, be sure to subscribe to our channel if you want more updates, more videos about paying off your mortgage, buying rental properties, and ultimately expanding your financial freedom. So why do banks hate lending out HELOCs? Well, for the purpose of this video, I'm specifically talking about second lien HELOCs, not first lien HELOCs. Now, just to set up the backdrop of the explanation, in the world of banking, there are two types of mortgages. One is known as the qualifying mortgages, and the other is known as the non-qualifying mortgages. A qualifying mortgage is your typical 30-year fixed rate mortgage that's given out to pretty much everybody, and this is the stuff that everyone gets to buy a home. Now, what's distinctive about a qualifying mortgage is that it's regulated by CFPB, the Consumer Financial Protection Bureau, and there are guidelines that are set by the federal government in order for a mortgage to be a qualified mortgage. The CFPB, Consumer Financial Protection Bureau, was established back in 2012, initiated by the Dodd-Frank Act, and this bureau creates the regulation as well as the guideline as to what mortgages are considered a qualifying mortgage. The CFPB creates guidelines as far as what FICO score is needed, what debt-to-income ratio is required, what disclosures needs to be given out to the borrowers to be considered a qualifying mortgage, and why you need to smash the like button on this video for the YouTube algorithm. So next time you go and shop for a 30-year rate mortgage or refinance mortgage, you're typically getting a qualifying mortgage from a broker or from a banker. A non-qualifying mortgage, on the other hand, follows a different guideline that is not necessarily set by Consumer Financial Protection Bureau. A non-qualifying mortgage, often abbreviated as non-QM, may often follow guidelines that don't look at credit or may overlook credit, or they may overlook debt-to-income ratio, and oftentimes that's why these non-QM loans have higher interest rates, because they don't follow the same guidelines that are set by the federal government. Most HELOCs fall into the non-qualifying mortgage category, and this is why I often say that not all HELOCs are created equal, because different banks and institutions may set their own guidelines and features as to how the HELOC is underwritten and what features are offered through the HELOC program. As in another example, the state of Texas has a completely different guideline as to how HELOCs need to be borrowed or how HELOCs need to be issued. So there could also be a state-specific guidelines when it comes to HELOCs and non-qualifying mortgages as well. Now, I really want you guys to remember the part of non-QM and QM distinction, because I'm going to show you why exactly the banks don't like lending out HELOCs, and it all has to do with this whole non-QM and QM conversation. After a bank gives you a 30-year mortgage, they'll likely sell the underlying note on the mortgage to a Wall Street type bankers to be sold and packaged into what's known as mortgage-backed security. And for those who don't quite understand the banking jargon, let me go and break this down into plain words. For example, let's say you borrowed $100,000 from Bank ABC as part of your 30-year mortgage. Now, what the Bank ABC will do is they'll sell the rights to be able to collect the monthly payments on the loan to another bank, Bank X, Y, and Z. Therefore, now you owe the $100,000 to Bank XYZ, not Bank ABC, because Bank ABC sold their right to the loan to another bank so that they can collect on the mortgage. But what Bank XYZ ultimately does is they buy hundreds of these, 100 different rights and different loans from different banks across the country and package them into a mega loan, and this is often known as the mortgage-backed securities. Because there are thousands of loans that are packaged into this one mega loan known as mortgage-backed security, it's deemed safer than just buying a single note, right? Because if 10 people default out of the 1,000 loans inside of this mortgage-backed security, well, there's still 990 other loans that are still performing, and the borrowers are paying back on the mortgage. Consequently, these mortgage-backed securities are now then sold to the market, and investors, people with 401k, IRAs, they can invest into the mortgage-backed securities and buy them just like how you would invest in stocks. So just to recap, you go and borrow a $100,000 mortgage from Bank ABC. Bank ABC then sells that note to another bank. The bank collects these different mortgages that are being lended out and turns it into a mega loan called mortgage-backed security, and then they sell the mortgage-backed security out to the public market, which then the interest that you pay on the mortgage ultimately goes to the interest that gets paid out on the mortgage-backed security. But as you can imagine, in order to sell more mortgage-backed securities, there has to be more of what? Mortgages, right? We need to create more mortgages. So therefore, the Wall Street bankers put more incentives to the individual bankers, telling them, hey, listen, we need more mortgages so that we can create more of these mortgage-backed securities. We want you, Bank ABC, to go and make more mortgages and lend out to more individuals and consumers. And remember, because qualifying mortgages follow the guidelines of the federal government does back some of these loans. Therefore, it's deemed even more safe than some of these non-qualifying mortgages. So as you can see, packaging different mortgages into a mortgage-backed security that's ultimately backed by the federal government is deemed safer than packaging non-QM loans at the end of the day. Now, when it comes to the second lien position HELOC, they are non-QM. So they don't necessarily follow the same steps as the qualifying mortgages do as how they're packaged into a mortgage-backed security. Therefore, these Wall Street type bankers aren't as interested in buying these non-QM second lien HELOCs because, well, they're not qualifying mortgages and they're not being backed by the federal government. Therefore, they have little to no incentive in packaging these HELOCs into a mortgage-backed security type of product. But on the flip side, first lien HELOCs do follow a similar pattern as the qualifying mortgages, as they also get sold to another banks or they get sold to a hedge fund company and ultimately gets turned into a version of a mortgage-backed security. Now, here's why banks hate giving out the second lien position HELOC. Remember the whole part about Wall Street packaging different loans into a mortgage-backed security and Wall Street needs more mortgages to feed, right, the animal, so to speak? Well, because there's no demand from these Wall Street type bankers to buy out some of these second lien position HELOC, the individual banks don't really much have an incentive for creating these second lien position HELOCs out to the consumers. With these individual banks, the money and the profit center is in creating these 30-year qualifying mortgages and selling them to the Wall Street type bankers, and there's some obviously fees to doing that. So obviously, because the Wall Street bankers aren't buying the second lien position HELOCs, therefore the bankers are thinking, well, since we're not getting paid much to do it, we're gonna promote less of it. We're gonna promote more of these 30-year qualifying mortgage stuff because, well, there's a demand for it and there's a bigger commission for originating 30-year mortgages. So at the end of the day, it's about what makes more money for these individual bankers. These banks know that they can make more money by selling 30-year mortgages versus issuing out HELOCs. So therefore, they're promoting more of the 30-year mortgages. They're putting more marketing dollars. They're putting more promotion, and they're trying to get the average Joes to get a 30-year mortgage because, again, it makes them money. For example, let's say you're a car salesman and one particular car model pays more in commission than the other car model. Obviously, you're gonna try to sell more of this car model because it pays more. Therefore, you're gonna kind of ignore, right? You don't really wanna talk about the other car model that pays less in commission. It's actually shocking how normal it is to get a 30-year mortgage to go buy a house when you can actually easily get a purchase HELOC to do the same. And you can see ultimately there's not much of an interest from the banks to educate the normal average Joes about how these banking systems work because, well, then the average Joes can make a better and an educated decision about what's benefiting them financially, not the banks that are out to make commissions on issuing out 30-year mortgages. So can you see why banks hate me for educating you guys on how HELOCs work and how you can use a HELOC to pay off your mortgage? But at the end of the day, I care about you guys, the non-bankers and the consumers. So with all that being said, I hope I shed some truth and some light as to how the banking system works, why do banks push the 30-year mortgage so much than a HELOC, and why banks hate issuing out HELOCs and also hate me for obviously talking about it and educating you guys on how this all works. So if you guys enjoyed this video, be sure to subscribe to our channel as well as leave your thoughts down below. What do you guys think about the banking system? Is it fair? Is it honest? Tell me below. I want to hear your thoughts. And go and check out some of the other videos we have about buying rental properties, paying down your mortgage, as well as investing in real estate.